Hello, everyone, and welcome to our webinar, Introduction to Medical Practice Incorporation. My name is Stephen Hunt, and I'm the National Lead for Financial Planning at MD Management. As you know, being a physician in Canada offers unique opportunities and challenges that other professions rarely, if ever, need to consider. When it comes to financial advice, you're uniquely positioned to benefit from someone with an intimate understanding of how to best manage money as it relates to your specific situation. Because let's face it, you're probably too time constrained and focused on your own area of expertise to pay attention to your finances to the same degree as dedicated professionals like us at MD Financial Management. Our presenter tonight, Mark Ranger, is a senior financial consultant in the Ottawa office, and he joined MD Management in 2006. Prior to that, he worked for a major Canadian financial institution. Mark graduated from Lakehead University with a Bachelor of Commerce degree. He holds the Certified Financial Planner and Chartered Investment Manager designations. Mark will take us through the content, but we will pause throughout to answer your questions along the way. So we do have a question and answer functionality. If you look at the bottom of your screen, we will use the Q&A function, and so please feel free to type in your questions as we go, and we'll get to as many questions as possible. And with that, I'll turn it over to Mark.
Thanks, Steve. Much appreciated. And thank you, everybody, for taking some time to join us this evening for our webinar, which, as Steve mentioned, will serve as an introduction to Medical Practice Incorporation. All right, so the agenda items that we're going to cover this evening are relevant if you're both new in practice and also want to find out about incorporation, or if you're already practicing and are paying down debt and thinking about building your wealth. Also important to note that we've designed this webinar to ensure you walk away with practical as well as actionable guidance on not just the mechanics of incorporation and its benefits, but also whether it makes sense for you based on your individual situation, and then also what the potential next steps might be. Now, as far as the agenda items are concerned, we are going to start off by introducing Medical Practice Incorporation and how it works. We're then going to walk through a case study that will outline making the incorporation decision. We're going to then summarize the advantages of incorporating and some other considerations for you to be aware of. And then we're going to follow that up with providing some information about how here at MD we can help. Now, before I even get into a discussion about incorporation, I think it's an important slide here to walk you through a physician's typical career trajectory and their related sources of income over time. So it goes without saying that on top of substantial time and effort, you've likely spent a lot of money to become a physician. And in fact, you may have amassed significant student debt with little expectation that your cash flow would ever have improved until after you completed your training. As a medical resident, you were remunerated as a salaried employee of your hospital or medical faculty. You got a regular and steady paycheck with taxes and government benefits deducted right from source, which really means that you didn't ever have to worry about deducting these on your own because your employer automatically would have taken care of it for you on your behalf. It's once you're in practice that your sources of income can be a lot more varied and potentially quite complicated, depending on where and how you decide to practice medicine. The consequences of whether or not you remain an employee or a self-employed physician are considerable, especially with respect to federal and provincial income tax obligations. Now, I think it's also important here to point out, as far as incorporation is concerned, the benefits of incorporation are available only to those physicians that are considered self-employed and thus earning self-employment income. So the decision about whether or not to incorporate is one you would typically make post-residency and only if you have your own practice and thus earning self-employment income. As a self-employed physician, you're considered an independent contractor, which means you're responsible for generating all of your own income, paying your personal as well as professional expenses, and then calculating and paying your own income taxes. As time goes on, your income's likely going to increase, which could mean that you'll have a heavy tax burden that could make it a little bit more difficult to reach your long-term financial goals without without tax planning and being involved. As you earn more money, the amount of tax you'll pay will increase and can certainly escalate to comprise over half of your earnings. But that said, you may have plans like extended travel, you may have parental leave planned or a sabbatical. This could also cause your income to vary from one year to the next. So to manage through these peaks and troughs in earnings, you may be looking to smooth out your cash flow over time. Now, in your later years, particularly during retirement, you'll be replacing your income you generated from working with income that you're now generating from your investment portfolio. And so, with all these different career um, uh, paths that we're talking about, you're going to be faced with decisions about your compensation that will directly impact your lifestyle, as well as the current level of tax that you'll have to pay. And so how you determine the best strategy at any point in time, including whether or not you choose to incorporate, this is something that we can help work on with you, a specialist at MD that exclusively helps serving the financial needs of physicians across the country. Now, one of the questions that we get very often from our physicians clients, especially those that are about to transition to practice or have just recently transitioned to practice, is when is it worthwhile to incorporate? And so, as I already mentioned on the previous slide, um, the first thing that you need to establish is whether or not you are self-employed and thus earning self-employed income. From there, it really just comes down to understanding your personal finances and what you're trying to accomplish and when. So questions like, how much do you have in savings? What's your debt level? And ultimately, if you need all of your income and can't afford to leave any money inside the corporation, or if you spend more than you earn, then there just may be no advantages to incorporating at this point in time. However, if the answer is yes to the majority of the questions that you see here on the screen, chances are that you would benefit from being incorporated. Incorporation offers a way to manage your income stream, helps you increase your wealth, and helps you save money through what we call tax deferral. While incorporation is suitable for physicians with their own medical practice who have money they can put aside, even if it's right for you, it can make your financial circumstances a lot more complex. So one thing I'd really like to stress on this slide is that getting personal advice is certainly key. If you're considering incorporation, we can also help you understand whether it makes financial sense for your situation even before you start paying the associated accounting and legal fees. If you've already decided on incorporation, we can also help you take the next steps to effectively address all the financial planning that needs to be done with an incorporated practice. All right, so before we get into the logistics of incorporation, you may or may not know that according to the Canadian Medical Association, CMA, a significant proportion of Canadian physicians with medical practices, they have opted to incorporate. And without a doubt, the biggest reason for them doing so is considered tax related. And so as a small business, an incorporated practice is subject to a special tax treatment. And this is because the Canadian government, they want to encourage small businesses to grow and reinvest in themselves. So in turn, this encourages growth and reinvestment in the Canadian economy. And so when I'm talking about this preferential tax treatment, it really comes in the form of a low corporate tax rate on the first $500,000 of what's called active or otherwise known as practice income. And even above the $500,000 active income mark, corporate taxes still remain lower than personal tax rates. And so based on this, paying less in taxes, it frees up money and thus incentivizes business owners to invest in anything related to their operations that then helps them move their businesses forward. So thinking about things like equipment, supplies, staffing requirements, etc. And then money that isn't spent on the business, this can then remain inside the corporation until it's required. So you don't pay any tax on this portion until later on, whenever you choose to withdraw it. In other words, being incorporated, that provides a way to defer some of your current tax burden. Ideally, you'll defer withdrawals until you're in a much lower tax bracket, at which point you'll no longer be paying as much tax on the withdrawn funds. Tax deferral, it also allows you to save more money without having to work more. In addition to contributing to RSPs and TFSAs, you can build investment savings within your corporation that you can then draw as income during your retirement. So based on this slide and what I've said so far, it's no wonder why so many self-employed physicians do choose to incorporate, because beyond sheltering some of their earnings from high personal taxes, incorporating also provides growth opportunities for both their medical practices and for them personally. And so you're going to see in a little bit later in today's session, we're going to be looking at more in detail at how you can take advantage of these attractive aspects of incorporation. So before we do that, I'd like to give you a better idea of the mechanics behind how incorporation works. And so I'd like to take some time to walk through the basics. So first off, when you incorporate, you're essentially now creating a legal entity that owns your medical practice. This means that you become a shareholder and a director or employee of the corporation. Other shareholders can also own the corporation. The corporation is separate from you as the individual, but you as the physician do control it, but the corporation independently earns income and thus pays tax on it. And so there's 2 points to be aware of regarding the separation between you as the physician and your corporation. Number one, the corporation is a separate taxpayer under the Canadian Income Tax Act, and certain types of income earned by the corporation may be taxed at a lower rate than if you earn them personally. And number two, a corporation is owned by its shareholders. While all voting shareholders are typically physician owned, a spouse, an adult child, and potentially others, depending on your province or territory, can also become shareholders and own non-voting shares.
Mark, I'm just going to pause there and remind the audience that we're absolutely willing to take questions along the way. So if you do have questions, please enter them in the Q&A section of the webinar interface at the bottom of the screen, and we will pause again in a couple of more slides to see if you have any questions. So I'll turn it back to you, Mark.
Thanks, Steve. All right, so let's put it into practice through a bit of a case study. Today, we're going to explore the first distinction between physician and corporation, namely that certain types of income earned by the corporation are taxed lower than if you earn them personally. And the example we're going to be showing here will compare how your earnings would be taxed as both an unincorporated physician and an incorporated physician. And please note, you'll find the same example in our guide on our incorporation website. So let's start with the unincorporated scenario. Let's say you earn $300,000 after paying for overhead expenses, but before paying any personal tax. You've decided you need $114,500 per year for your living expenses, but you also want to maximize your RSP and TFSA contributions of $26,500 and $6,000 respectively. So in totality, you've calculated that your financial needs amount to about $147,000. If you earn your professional income of $300,000 personally and an unincorporated physician, you'll pay an estimated about $108,000 in annual personal taxes, which would leave you with about $192,000 of after-tax personal cash flow for the year to live on, save, and invest. So once you account for that $147,000 in combined living expenses and RSP contributions and TFSA contributions, you'll see here that you have about $45,000 left over to invest outside of an RSP or TFSA in what we would call non-registered savings. Now, instead, if you choose to incorporate, your medical practice will now earn the $300,000 through the corporation, and it would pay about $4,000 a year in administrative costs. Now, from the corporation, you would need to pay yourself. You need to pay yourself. You need to pay yourself a salary of about $212,000 before tax, which allows you to maintain your desired lifestyle, as well as maximize your RSP and TFSA contributions at the same level than if you were unincorporated. Now, here's where the biggest difference between being incorporated versus unincorporated would emerge. After paying the $212,000 of personal salary and the corporation's administrative costs, you would leave about $84,000 of your practice income inside the corporation, where it's then taxed at that small business tax rate of approximately 12%, depending on your province or territory. The corporate tax rate is considerably lower than your personal tax rate, and you can certainly see the outcome of this. In an incorporated scenario, you'd have almost $29,000 more in investable assets than if your medical practice wasn't incorporated. Now, I've mentioned a few times that this $212,000 would be considered gross and pre-tax, so you would have to pay personal taxes on it. However, because you've received almost $100,000 less personally, and after factoring in that RSP contribution, your estimated personal taxes owing would drop to about $65,000 when compared to $108,000 in the unincorporated scenario. So you're still far ahead. Now, just to summarize and to stack both scenarios side by side, you'll see in this case that the tax deferral advantage is nearly $29,000. And please note this is an annual calculation. So all things being equal, income, expenses, the savings personally, this would be a tax deferral benefit on a yearly basis, which would slightly differ based on different figures. Now, as you've seen thus far, the ability to defer income tax is certainly the #1 advantage to incorporating. With marginal tax rates for individuals exceeding 50%, depending on the province or territory, corporate tax rates are relatively much more attractive. And in fact, the most tax you'll ever pay on active business income is approximately 28% on average across Canada. And that's only on earnings that wouldn't qualify for the small business tax rate. You benefit even more by paying taxes in the neighborhood of 12%, depending on your province or territory, when your professional earnings do qualify for the small business rate, as you see on the previous slide when we went through the example. In most provinces, it's also good to note that the small business tax rate income limit is about $500,000. So based on all of this, it's fairly simple math. The less tax you pay, the more money you have to save every year. And over time, this tax deferral advantage only gets more powerful as you collect and grow more of your savings inside your corporation. Now, keep in mind, though, there are other factors that can impact that small business threshold of 500,000. It may need to be shared with an associated corporation. It may be limited due to a partnership. It may be reduced due to levels of corporate passive investment income. It can be manipulated through varying levels of compensation, and it also can be impacted by additional tax issues such as with US persons. Now, how do you make the most of this tax deferral advantage? Well, by using the money you saved on tax through your corporation to support a whole host of short and long-term financial needs, which could be both business related and for your personal benefit. For example, you may have some large business expenses in your practice, like offering benefits to your employees, or you may have business debt because you bought into a medical building or you've invested in some expensive equipment. While there's no getting around these costs, you may be able to pay for them, or at least the financing used to acquire them, much more efficiently from inside the corporate structure using the corporation's cash flow. And to reach your longer term goals like retirement, your corporation provides a way to save and invest beyond the maximum allowable in your RSP and TFSA by keeping more of your earnings and growing your wealth more effectively. And then eventually, when you take the money outside of your corporation, likely during retirement, you'll have to pay tax on these withdrawals, but at that point, you may well be in a much lower tax bracket. So in that sense, you've not just deferred tax, but you've saved tax as well.
Great, thanks, Mark. We'll give you a break for a minute, and we do have a couple of questions. Joining us in the webinar today, we have two of our incorporation experts here at MD Management. We have Angela Campbell, who is the Assistant Vice President of our Tax Advisory Services Department. And she is with the group and she supports MD advisors and clients by providing tax information and tax education on physician incorporation, private corporations, cross-border, and personal tax issues. She has over 18 years of tax experience advising on an extensive range of personal and corporate tax matters. And Lowell Thiessen is a certified financial planner and a registered financial planner who's been working at MD for more than 25 years, much of that time as a wealth lead, where he focuses on financial planning advice related to medical professional corporations, as well as advanced financial planning and related tools. So, in fact, I'm going to start with Lowell and ask him the first question. And the example is that if I have a corporation for several years and then later become a salaried employee for the rest of my career, what are the tasks or the fees associated with dissolving the corporation?
Thanks, Steve. We'll talk to costs again in a little bit later, but I'll jump to some of the aspects here and evolve this into a little more complicated scenario, starting simply. Accounting is often one of the largest ongoing costs. College registration fees are typically in the hundreds of dollars. Legal and marketing costs are usually much more periodic based. So looking at a situation where somebody has stopped needing their corporation, the accounting fees you're going to make the situation simpler. So even if you don't drive those to zero right away, hopefully you're taking less time and energy from your tax experts, and so those costs should go down. You don't need to maintain active registration of the corporation with the college if it's not being used actively, so that cost would disappear. In terms of legal and marketing, if you're going to wind it up, you'll pay some fees typically to a legal professional to help on that front. Marketing, I mentioned from the perspective of you've just changed how you're practicing. That's practicing as a professional corporation does require that you disclose that you're practicing as such. So you may have to change business cards and some of those pieces. So those are are pieces to keep in mind as far as tasks or costs that might change. And that's in a situation where it's pretty cut and dry that you're not going to use it anymore. What if it's a little more complicated, that it's either a complicated structure or you've built up a bunch of money in the corporation, or there's some other opportunity that might evolve down the road. And this will tie into another question, at least to a small degree. It's not a requirement that you wind up the corporation right away. And in fact, there are situations when it might not be worthwhile. So it may well be that you can substantially reduce your costs until you start using the corporation again. And then it depends on what was the reason. Is it because you've got a long-term investment of some sort in there that you want to keep the corporation intact until that sorts itself out? Is it because you've got the possibility of practicing in another province and it's more about moving a corporation or something of that sort? So hopefully that gives you some sense of the tasks that perhaps should be on your mind or could be on your mind. As always, talk to an individual to get the tailored side of the equation.
Well, I'll stay with you because another question, which I think is very similar. So whether the corp is dissolved or maybe this person has now moved into a salary position, does the money have to be taken out immediately? And what about the taxes or a significant huge tax bill in that specific year?
Sure, and the answer is easily no. It does not have to be taken out immediately. So if it's an issue of spending $1,000 a year to keep the corporation in order to save 10 or 20 or $50,000 of tax by spreading out your distributions, absolutely, that's your decision to make. It's just a matter of balancing out what are the pros and cons. But certainly you've got that flexibility. And if the timing happens to be bad, that's one of the reasons why typically you've got a corporation in the first place, is to help spread it out and avoid those large tax consequences.
Great. Thank you, Lowell. Now I'll turn it over to Angela, our tax expert, to answer the next question. And could you explain or demonstrate how the concept of tax integration works?
Yeah, thanks, Steve. Yeah, this question comes up a lot, and it's really fundamental to our tax system in Canada. And tax integration basically means that you really should be in the same position, whether you earn $1 of income personally or whether you earn it through a corporation. So what really makes the difference between being incorporated or not is the timing of when you pay your tax. And just for an example, so if we take that sort of highest marginal tax rate, using the numbers in our slide deck tonight in terms of tax rates, personally, if you're paying tax at a 50% tax rate, and we've mentioned that in your corporation, if you can access the small business tax rate, you'll pay tax on your corporate earnings of around 12%. When you distribute the earnings, that after-tax corporate earnings to yourself personally in the form of a dividend, generally speaking, through the concept of integration, you'll pay tax at around 38%. So at the end of the day, you'll pay the same 50% tax, but by using a corporation, you can pay 12% today and 38% in the future. But in the end, it generally should be the same. But in practice, of course, integration isn't always perfect, so there can be some provinces where it can make more sense to incorporate or not based on the way integration is working, and it's best to speak with your particular tax advisor who's really kind of monitors where integration is at any point in time. I may just take 1 second to go back to that previous question, just to clarify. I think the question was when a corporation is dissolved, does all the money have to be taken out immediately and are taxes paid at once? And just technically, if you actually dissolve a corporation, that means you actually shut it right down. And in that case, you do have to take everything out and pay tax. But what Lowell was mentioning is that you know, you don't necessarily have to dissolve that corporation. So if you are in a situation where you're using your corporation, but then become salaried later on, you can keep the corporation in place and keep it in existence. And then you don't have to necessarily dissolve it, so you don't have to take that income at that one time, and you can actually do some planning to see about distributing it out in the future.
Thanks, Angela. So let's answer one more question now, and then we'll continue on with the rest of the content. And it's around, is there a specific earnings threshold that one should consider reaching before they incorporate? Lowell, I'll turn that one to you.
Thanks, Steve, and thanks, Angela. I'll be more precise on this one. we'll pick on the earnings part of the question first. That I'd rather see the focus on retention as opposed to earnings. That it's less about how much your corporation makes or your practice makes, and it's more about the retention side of the equation. That's where you'll get the biggest bang for your buck. In terms of, is there a threshold you should reach before incorporation makes sense? The bigger the number, the better, generally speaking. But we've seen lots of physicians who will actually start earlier just from a simplicity perspective. So the situation in my mind on that front is you're in a high income specialty and you're looking to start up your practice, even if you've got some debts and your house purchase and some of those pieces that are going to make cash flow tight in the first few years, the reality is you're going to get to a point where you're going to incorporate, and rather than going through the process of changing your referral networks and everything and managing everyone's understanding that you're practicing as a corporation versus not. We've seen many situations where someone who knows they'll get there will start early. Is it the end of the world if you don't start early and you wait until you're sure? Not at all. And so if you want to make sure that it's in your best interests, you can wait as well. So if you're worried that I'm hedging on a specific number here, it's intentional. Focus first on retention. Second, identify whether you're going to do it at some point or not. If you know you are and it will be simpler for you, certainly it can be worthwhile doing it early. If you know you're going to be moving to another province in 3 years, it might be worthwhile waiting just to help with managing the complexity. And if you're still waiting desperately for a magic number, give you the general guideline of our average professional corporation retains between $50,000 and $100,000 per year. So if you want to know how you fit compared to your peers, and that's somehow meaningful, there's one numerical figure you can toss in or keep and hang your hat on as well.
Great, thank you, Lowell. Okay, I'll turn it back to Mark, but we do have a few more slides of content, but we will absolutely spend as much time answering questions after that. So feel free to keep the questions coming, and we'll get to as many as possible at the end of the session. So over to you, Mark.
Thanks, Steve, and thanks, Angela and Lowell. And even just to touch on that question that Lowell just answered, that's one that I get very often in terms of how much do I need to make? And I would wholeheartedly agree with Lowell. It really is more about the retention inside the corporation that makes the most sense. And to put things into perspective, there's some specialists that I'll meet with that make between $500,000 and $1 million, and incorporation doesn't make sense because of lifestyle reasons. And I've met with family physicians that make a couple $100,000 a year, and it does make sense to incorporate because they're in a position where they can retain inside their corporation. So it really is to focus more on what you're able to save versus how much you're actually earning. All right, so to get back to the content, we've talked a lot about the tax deferral benefit of incorporation, but once we determine that you should incorporate and you proceed with that, there are other things for us to be looking at in terms of making incorporating even more worthwhile. So on the screen, you'll see there's 5 different aspects to sort of sift through, and I'm going to briefly talk through each one. So from a banking perspective, your corporation will need a bank account in the name of your corporation, and it may actually as well. And so a banker with professional corporation expertise will most, and we can certainly refer you to a banker that is familiar with medical practice incorporation, so that they bring greater benefit than if you're dealing with someone that just doesn't understand medical practice incorporation and doesn't have that relevant experience. From an asset allocation perspective, how you structure your investment portfolio to manage your corporate assets provides additional opportunities to be tax efficient. And this is because the investment income that you're earning inside your corporation is taxable. And so tax planning should be at the forefront and certainly part of your wealth management process, so that you have an accurate picture of what investments make the most sense for your corporation. RSPs and specifically RSP, spousal RSPs, we recommend saving for retirement under both a corporate structure and by investing in RSPs and a spousal RSP if applicable. Saving for retirement within your corporation shouldn't replace your personal registered plan savings because of the additional tax deferral benefits that are awarded to RSPs and spousal RSPs. And when we talk about spousal RSPs, they offer the ability to split income with your spouse if they happen to be in a lower tax bracket, which would bring greater tax savings. Income sprinkling. What we're talking about here is if you're married and you're incorporated when you turn 65 and your spouse happens to be in a lower tax bracket, you can choose to pay them dividends to help reduce taxes. And with this strategy, commonly referred to as income sprinkling, you as the director can declare dividends for specific classes of shares. And that is, if your spouse makes less income and is in a lower tax bracket, you can simply declare dividends for that spouse only. And as long as your spouse is a shareholder and your corporation is still active, you can income sprinkle with them without being subject to the new reasonableness tests that were introduced back in 2018. And if you're retired, you can still income sprinkle to draw down on your retained earnings. And finally, insurance. A life insurance policy bought with corporate funds can have several benefits, and it almost goes back to the same concept where we were talking about paying for business expenses. The lower tax rate applied to the funds in the corporation makes this a much more efficient way to help pay for insurance. And with the money you save on taxes, you can consider buying permanent life insurance, which does tend to be a lot more costly than term life insurance. But permanent life insurance is being used in this case for very different purposes than term life insurance, namely tax sheltering, retirement and estate planning specifically. So it's worth noting that when it comes to term life insurance, you'll still want to make sure that you're covered by this type of insurance for lifestyle protection outside of the corporation. And that also goes for not just term life insurance, but disability and critical illness insurance as well. Now, we've talked a lot about the benefits of incorporating. And so I think it's also important that we touch on the fact that there are some disadvantages to incorporating as well. So there's clearly a lot to think about before deciding to incorporate. But incorporation, it does come with extra costs and complexity, most associated with record keeping and bookkeeping. So you'll have to deal with a lawyer and an accountant. You'll have to pay upfront and ongoing legal and accounting fees, as Lowell was mentioning earlier in one of the questions. There's a fee for the professional licensing body that you'll have to pay. You'll need to pay corporate registration, and you'll also need to get consent to practice medicine through your corporation. And then when it comes to the administrative side, you'll have to manage a corporate shareholder agreement. You'll have to complete a separate tax filing every year for your corporation, which will include an annual tax return, preparing T4 and T5 income tax slips. And then you'll have to remit monthly source deductions, so income taxes and Canada pension plan contributions on salaries paid to you and other employees. So your team of MD professionals and our specialist partners, we do have a wealth of experience with regards to incorporation and can certainly help educate you and help you manage some of these, what would be considered disadvantages of incorporating. Now, there's some other potential snags that are worth showing here on the screen, and they're less common in terms of being issues, but they certainly could impact you either positively or negatively. And so if you believe that any of these ever apply to you, or if you have questions about any of them, please refer to our incorporation guide on our website, or be in touch with us to learn more. And so tonight, we're not going to get into each and every one of these potential pitfalls or snags, but the one that I do want to call out is the tax implications of passive income, because this is certainly a reality that many of you that are incorporated will face, especially as time goes on. So as I mentioned earlier in the presentation, there are two types of income within a professional corporation. There's your active income, which is the money generated from your practice. And then there's passive income, which is the income earned from the investments inside your corporation. And so we've talked a lot about the benefits of tax deferral on your active business income, but these benefits generally don't apply to the passive income earned from the investments inside your corporation. And in fact, as Angela mentioned in one of her questions, the investment income is going to be taxed similar to the top personal tax rates in Canada from your corporation's perspective. So that is something to be fully aware of. But if there is one thing to take away from this webinar this evening, regardless of the fact that there's tax consequences on investment income, incorporation, even when you take into account some of the changes that were made in 2018 legislatively across the country, incorporation still offers many more options for tax smart and saving that you'll have to your disposal than by staying unincorporated. But in some cases, or sometimes even in many cases, accountants, insurance agents, financial advisors don't necessarily strategize together and aren't aware of the significant tax advantages of incorporating for the right candidates in the right way. So it's very important that you work with a team, you assemble a team of professionals who can not only help you decide if incorporation is right for you, but then also help you manage your assets in your corporation following that. All right, so to that end, we did want to provide a little bit of background about who we are at MD. We are the only national financial services firm exclusively dedicated to the financial well-being of Canadian physicians and their families. We have a long history of providing physicians with guidance. In fact, this is our 50th year in existence. And although incorporating hasn't been around that long for physicians, we've certainly been here to provide advice and practical solutions regarding incorporation since it has been available for physicians in Canada. We go well beyond helping make helping make the right decision around incorporation. We want to look at, as I mentioned in one of the previous slides, we want to really help with optimizing your corporation and your financial plan as an incorporated physician, which is going to start by developing a clear understanding of your current situation, your future objectives, and then collaborating with a team of specialists. So you'll work with a financial advisor like myself, but also there's internal specialists that can really help engineer and customize your wealth management strategy. This will also recommend us having you recommend to banking experts and providing advice on where to invest your corporation's assets. As we touched on with passive investment income, as well as your RSP and TFSA investment portfolios, different types of investments do have different tax consequences. So we're here to help show how to invest tax efficiently and help ensure that you're getting good value on your investable assets inside your corporation. And as your situation evolves and becomes more complex, we can serve as the point person to help monitor and update your comprehensive financial plan as required. We can help you prepare the right strategies for when it comes time to retire, and we can also help develop your estate plan and your estate planning issues. So in other words, we can help meet all of your financial planning needs right across the entire spectrum, as well as your entire career. So we really hope you found today's webinar engaging and informative. Here's how you can contact us for more incorporation related information.
Great. Thanks, Mark. I'll take it from here. I appreciate you taking us through the content, and thank you to everyone who has submitted questions. So we're going to jump right into the Q&A. Feel free to continue to ask questions as we go along, and we'll keep Lowell and Angela busy for a little while. So maybe we'll turn it to Angela first, and that is, when does corporate income not qualify for the small business tax rate? Is that an easy answer, or is that a long answer?
Well, it depends. Depends on how much you want to talk about it. But from the physician context, you really want to look at, I guess, touch back on something, Mark, you said about what types of income are earned in a corporation. So generally speaking, you have your active business income or your professional income, and then as you retain money in your corporation and earn investment income on it, that type of income is commonly referred to as passive income. So if you want to look at your corporation, you might have two types of income in it, this active business income and the passive income. And the small business tax rate is only accessible on your active business income. So for small business corporations in Canada, they have access to the small business tax rate on the first $500,000 of active business income. Passive income, on the other hand, is taxed at higher rates. Generally, in a corporation, they may be even closer to that 50% personal tax rate. But touching back on that integration question, you might be wondering, well, if I pay 50% on passive income in my corporation, am I going to be stuck with that, paying more tax when I take the money out of the corporation? And the answer is yes, you'll pay more personal tax when you take the money out of your corporation, but your corporation actually will get some tax refunded to it. So integration still holds on passive income for those that may be wondering. But for the corporate side, you generally would have access to your small business tax rate on all of your active business income up to that $500,000. After that, you pay tax at your general corporate tax rate, which will run you, but it's different province to province, but it's going to average around 26%. And if you are in a situation where you pay tax at that general corporate tax rate, then using that concept of integration, the dividends that you pay out of the corporation are subject to lower personal tax rates. So again, you sort of preserve the concept of integration. There are situations that you may have heard about where you would lose access to the small business tax rate. And most notably for physicians, it's when your passive income inside your corporation exceeds $50,000. So once you start to retain a lot of funds in your corporation and you're earning a lot of passive income, you will start to lose access to that small business tax rate after that passive income exceeds $50,000. And you fully lose it once it reaches $150,000. Of course, you have time to plan for that, and there are things you can do to manage that situation. As a final note, I'll mention just Quebec, just in case there's anyone listening in from Quebec, because Quebec physicians who are incorporated actually generally lose that small business tax rate even on that first $500,000 of income, because Quebec has some rules that say if you don't have employees inside your corporation that are completing around 5,500 hours of work a year, then the corporation is not eligible for the small business tax rate personally. They still do get it federally though. And I'll leave it. Anyone else, anything to add or?
Yeah, just to add to Angela's points. So she had mentioned losing access to the small business limit when you start earning excessive amounts of passive investment income. I just wanted to go back to one of the slides that I had mentioned. There are a few other situations that would allow for a potential reduction in the small business threshold. So again, it may need to be shared with an associated corporation. So if you are a voting or a non-voting shareholder for another corporation, that could mean that you need to then share that small business limit amongst both corporations. It could also be due to a partnership. So legislation, I believe back in 2016 was passed that if you're part of a partnership that say has 100 physicians, you may be subject to having to share that 500,000 small business limit with every single physician in that partnership. So that would then mean that you have less access to the $500,000 as one of those physicians in that greater partnership. It can also be manipulated through varying compensation. So by paying yourself salary versus dividends would then dictate how much you're leaving in the corporation, which could then also give rise to a reduction in how much small business threshold you have access to. And then finally, the U.S. person. So if you have anyone in the corporation that's considered a dual citizen with the United States, whether it be the physician or a non-voting shareholder, that can also give rise to tax issues that would mean that small business threshold is impacted.
Thanks, Mark. And actually, I'm going to turn it back to Angela again, because there is another question that's relating to this. So let's talk about it while we're on the subject, and that is, how do we prevent your spouse's corporation or another physician's corporation in the clinic for potentially becoming associated with your corporation?
Sure. Thanks. So you had mentioned that that the 500,000 small business deduction limit needs to be shared among an associated group of corporations, which is absolutely true. When you're looking at the association rules, you want to look at, if you control your MPC, your medical professional corporation, and you also have control of another corporation, well, those corporations would be deemed to be associated with another. If you have a corporation and your spouse has a corporation, well, those are on the surface are not associated with each other. What needs to happen for them to be associated with one another is there has to be a cross ownership of shares. So you would have to have at least 25% of your spouse's corporation as well for those two corporations to be associated. So you do absolutely have to look at, any investments you have in other corporations to kind of consider those associated rules. But I would think in a clinic, you would want to look at what are the shareholdings of all the corporations and who has control of them. If you have a group of people that control one corporation and the exact same group control another, that's another situation where those two corporations could be considered to be associated with each other as well.
Thanks, Angela. Okay, so let's jump to another topic here, and I'll throw it to Lowell. Lowell, what type of assets generally would be more efficient in a corporation? And the presumption with this question is not fixed income because it is passive income and potentially taxed at a higher rate. Can you talk to that for us?
Absolutely, and point well taken. Interest income is fully taxable. That's not true of other types of investment income. So let's start there first. That typically the number one answer is capital gains or anything that's going to grow in value. And for a variety of reasons. First, there's a deferral aspect that it's not taxed until it's realized. So if you hold on to the investment and don't realize that gain, you're going to get a deferral benefit. When it is realized, only half of it's taxable, so much lower tax consequence by only half being taxable. Third, efficient distributions from the corporation. That's the tax-free portion is not only tax-free to the corporation, but it can be distributed out of the corporation tax-free. So that's another benefit. It will help with passive income clawback rules. That half taxable aspect and the deferral aspects are both a benefit there. And then there's the return potential that usually investments that are growth oriented will have higher return potential. So for all of those reasons, capital gains are often the number one piece that people are looking to. I'm going to emphasize here that stuff that generates capital gains is growth. It's not guaranteed, and so there's a risk element in play there, and it should not be the tail wagging the dog in that the tax issue is important, but the portfolio that's appropriate for you should be the starting point, and then figuring out how much of that should be in capital gains is a secondary piece. Unpacking to some other different investment income types and different assets, because that was the broader nature of the question. Dividends income is attractive, or most attractive, typically in retirement. And I'll emphasize that it's Canadian dividends only. Foreign income is like interest income and fully taxable, so that's not going to help. Real estate is often a mix of income types where you can get some growth, but also some income, and in rental income is going to be fully taxable. As Mark mentioned, an insurance shelter might solve all of those problems for you, where tax becomes a moot point. So it's not absolutely necessary that you avoid interest income. You just may need to take advantage of a wrapper that you've got to protect. Some other quick pieces, I'll emphasize assets not to put in your corporation. Your principal residence is typically a bad idea for a bunch of reasons. And on the flip side, another asset to consider for your corporation is business-related assets. So especially if you need to borrow for them, that repaying the capital of the asset is much more effectively done with 90-cent corporate dollars than with 50-cent personal dollars. So hopefully that gives the quick answer of capital gains and a little bit broader depth of some of the other assets that maybe should be or could be on your radar.
Thanks, Lowell. I'm going to keep it with you for the next question. So aside from registering with the college, what do I have to do to be able to practice medicine as a corporation, considering that I'm still earning income as an individual and my scope of clinical practice is unchanged?
What must you do? Well, let's start with billing systems, I suppose. The nature of how you bill can vary by province, and I must admit I'm not up to speed on every province and all of the current rules, but imagine two very different situations. One where your billing system only gives a number to you personally as a physician, and you're allocating that money to your corporation, versus a province where the billing system does allow the corporation, or requires, in fact, the corporation to be the one that obtains the billing number. So in terms of a requirement, I would certainly check with legal counsel to make sure that you're still compliant with your billing system. In terms of more practical, so I'll slide away from the required and more what perhaps should you keep in mind. So the number one thing that comes to mind for me is keep your records segregated. So don't mix your personal and business side, or your business practice and your corporate side. So simple pieces as different bank accounts, different boxes for your expenses. Credit can get a little grayer there. Sometimes there's the ability to mesh it, but there are certainly tax issues that have to be managed if you're doing that. So my number one, I guess, would be billing systems on the must, and my number two would be segregate your records. Keep those two methods of practicing separate.
Thanks, Lowell. Mark?
And just to piggyback on what Lowell's just said, I would argue that regardless of being incorporated, I would suggest that you keep your records separate for business versus personal. And that's something that we hear a lot of accountants that we work with closely in terms of mutual clients say. So it's probably more important once you incorporate, but in terms of protecting yourself from CRA, in terms of what's considered personal and business, having a separate bank account for business-related income and expenses, and a separate credit card for business-related expenses would be something I would certainly suggest.
Thanks, Mark. I believe we've answered the next question, which is how is investment income such as capital gains taxed differently within a CCPC or in this case, a medical professional corporation. So I'll leave that one as is. If whoever asked that question, if there's a specific piece that we didn't get to, feel free to expand on the question further, but we'll jump to the next one and I'll ask Angela, from a taxation perspective, what is the difference between paying yourself a salary versus dividends, assuming that you are the sole shareholder?
Sure. Well, I mean, really, it just comes down to sort of what tax rates you're going to pay on the income when you're looking at that tax perspective. So, if you earn your money through a corporation and then pay yourself a salary, you're essentially really going to be in the same position as if you earned that money personally. So, from a corporation standpoint, paying a salary, the amount that you actually pay to yourself as a salary is a deduction from the corporation. So you'll have your medical practice income, you'll deduct the salary that you pay to yourself, and then the net amount will be taxable in the corporation at that small business tax rate. The salary itself will be taxable to you personally, and so will be taxable to you at whatever tax rate you are, whatever marginal tax rate you're at. Um, Dividends, on the other hand, if you think about those, are paid out of a corporation from its after-tax earnings. So they are not deductible to the corporation. So if you do not pay yourself a salary, you take your medical practice income that's earned in the corporation and that net of other expenses you may have, and what's remaining would be eligible to be paid to you as a dividend. If you would like, and dividends are then taxed at dividend tax rates. And as I mentioned, that whole concept of integration, dividend tax rates are lower than the tax rates paid on salary, but at the end of the day, you're essentially will pay the same amount of tax overall, or approximately. There are some differences with salary, though. One of the things that you do entitle yourself to by paying yourself a salary is RRSP room. So by paying yourself a salary, you have earned income that will entitle you to make RSP contributions that you can then deduct from that personal income and save yourself some tax, and start your saving through an RSP as well. Mark, did you have something to add?
I guess the only other thing would be Canada Pension Plan contributions as well.
That's right.
So with salary, you'd be making those contributions and then entitled to Canada Pension Plan benefits at age 60 if you're taking it early, or regular age 65 or delaying till age 70.
Right. So there can be a cost to the salary
Right.
because it is a cost to you to make those contributions to the Canada Pension Plan, but then there is obviously some benefit at the end of the day.
Right.
Great, thanks, Angela. And I'll keep it with you. We do have one final question here, so I will make the call for final questions. Feel free to type them in as I ask Angela this last one. Do you have any advice on year-end dates, or I guess does it matter where we
No.
put our year-end?
No, I mean, it really doesn't matter. You can choose a year end. Generally, I would say choose a year end that works for you. So pick a time of the year where you have the most time to get yourself organized. And you might have, because you'll have some accounting records to put together to give to your accountant to prepare your year-end financial statements and do your annual tax filings, which are due about 6 months after your year end, but your accountant is going to want the information a bit earlier than that. And any taxes you owe are generally due 3 months after your end. So really, you probably want to get your stuff into your accountant within a couple months after your end. So ideally, pick a year end that works for you. And barring that, if you're busy all year, you may want to talk to your accountant about what dates may work for them. So I do know there are some accountants out there that actually have charge lower fees actually for off calendar year ends, because a lot of corporations tend to have a December year end, and it causes a busy time of year for accountants trying to deal with March 31st payments and then June 30th tax filings. So any one of those would help, but really anything goes.
Perfect. Thank you, Angela. Lowell, thank you. Mark, thank you for your presentation today, and thank you to all of our attendees. We appreciate your engagement. And there were a few questions on investment and taxation on passive income versus active income. We have another webinar tomorrow evening that digs into the next level of focusing on a corporation when you have been incorporated for a while and thinking about investment strategies. And so feel free to join us for that webinar at the same time tomorrow evening. And with that, I'll sign off. Thank you very much, and thank you for everything you do for Canadians in helping them with their health and well-being. Good night.